Welcome to the Options Impact Video Education. This is Tier 1, Options Basics. Cluster 1, the Options Contract. Title, Important Options Terminology. For Market Taker Mentoring, LLC at www.markettaker.com. First, we'll start with our disclosures and disclaimers. Options are not for everyone. You should read the characteristics and risks of standardized options before trading. You can get a copy at 1-888 Options or by visiting the Options Clearing Corporation. Fantastic! Let's get started. Today, we're discussing important options terminology. So first on our agenda, we'll be discussing the differences between intrinsic and extrinsic value. After that, we'll be discussing what moneyness is and how moneyness and intrinsic and extrinsic value are all interlocked, and how traders throw around terms such as in the money or at the money or out of the money all the time just to get us all up to speed and comfortable with the terminology. Then we'll be discussing Expiration Friday. So the third Friday of every month is very important to traders. And then we'll be looking at an overview of a cash flow example. Okay, so let's get started. So our intrinsic value. So an options value is made up of two components, the intrinsic value and the extrinsic value. And the first thing we're going to look at is our value of the long call. This is going to be the difference between the stock price and the strike price. Now remember, in a long call, you're hoping that the stock price goes up because you have the right but not the obligation to buy at a cheaper price. So in that case, the higher the stock price, the more valuable that call option is. So now you might be looking at the formula and saying, but wait, it's a little bit more than just the difference between the stock price and the strike price. It's the max of the stock price minus the strike, or 0. And the reason why we have this 0 there is because there could be a situation when the strike price is higher than the stock price. Well, what's the trader going to do then? Well, the trader will let that option expire worthless. So in that scenario, there is no intrinsic value. That doesn't mean the option has no value, but the intrinsic value is 0. And so that's where the optionality aspect comes into play. So again, with a long call, you're hoping that the stock increases in value, so you'll be able to make more from the stock price and the strike price. Now what about the long put? This is the right but not the obligation to sell the underlying asset. So what you're hoping for is that the stock price actually decreases in value. So this is a scenario where you're hoping that the stock price goes all the way down to 0. And that way you can have a nice big maximum of the strike price. So, but what happens if the stock price is higher than the strike price? Are you going to sell then? Probably not. So what you're going to do is you are going to let that option expire worthless. And again, that's why we have our maximum of the strike price minus the stock price, or 0. Now, again, our long call and our short call are the exact opposites. Just like our long put and our short put are exact opposites. So when we're looking at the value of the short call, it makes sense that the intrinsic value is really the opposite of the stock price minus the strike price, or 0. Because you're hoping, as a short seller, that the intrinsic value is 0 so that you can collect all your premium. And the same thing for your short put. You're hoping that the value of that intrinsic value is 0, again, because that means you get to keep all that premium that you've sold. So now let's say that we have an option and we have a stock price at $6 and a strike price that's $4. So we have a value of $2 for intrinsic value. But let's say that this option is trading for $2.05. Where does that 5 cents come from? Well, that's our extrinsic value. That is our time value of the option itself. And that is how you can take apart and put it back together the value of the option itself. So remember, it's comprised of its intrinsic and its extrinsic value. So traders throw around this term called moneyness quite a bit. And when an option is in the money, we're going to say that it has intrinsic value. So for the case of the long call, when our stock price is $6 and our strike price is $4, we have an in-the-money value or an intrinsic value of $2. But what happens if that strike price was $6 and the stock price was $4? Well, that would mean that the option is out of the money. It has no intrinsic value. And our third scenario is, what if the intrinsic value, or the value of the stock, was $4 and the value of the strike was $4? So our intrinsic value again is $0. What happens then? Well, that means that the option is considered at the money. And in this scenario, again, there is no intrinsic value because the owner of the option wouldn't necessarily go ahead and exercise, because they could just buy it, the underlying asset, or sell the underlying asset at the market price. Now, when the option is in the money for a call, the stock price is higher than the strike price. And when it's in the money for a put, the strike price is higher than the stock price. And the reverse is true for out of the money. When it's out of the money for a call option, we're going to have a higher strike than a stock, and for a put option, we're going to have a higher stock than strike. But at the money, for both calls and puts, that is when the stock price equals the strike price. So Expiration Friday is just a big exciting event, and this is when all of the options expire, or all of your monthly options expire. They expire on the third Friday of every month. And it becomes a very just exciting day all around in the marketplace. So now we're going to go through a quick example of what happens from when a long buyer decides to exercise their underlying shares and what that does to the short side trader. So when you exercise, you're going to start off by saying your buyer decides to exercise. Then the buyer is going to notify their clearing firm. Their clearing firm will notify the clearing house, and your clearing house is then going to choose a seller at random. And then the seller that is chosen at random is considered assigned. They are legally contracted to sell those options to the buyer. So this is the case of a short call seller versus a long call buyer. And if you're wondering why you haven't seen that before, it's because your broker takes care of all of this for you. So now we're going to go over a quick cash flow timeline. So first, somebody decides to purchase a call option. The account balance is going to decrease by the option value and the commission, the amount that it costs to actually make the trade. Now, good news, the underlying stock goes up in value. So you decide to exercise the option. Your account balance is now going to decrease by the strike price times the number of shares. And remember that each contract is worth 100 shares. And then you're going to sell your new shares at the current price. Your account balance is going to increase by the stock times the number of shares minus any taxes or commission. So here's a working example. So we're going to purchase a SPY Feb 130 call for $1.86. So this is going to cost us $186 plus the commission. And $186 because it's 100 shares. And then our SPY is going to increase to $160. So we've made money. So what we're going to do is then buy the underlying stock for $130 per share, which is 100 shares, so it's going to cost us $13,000. So our account balance is going to drop by 13 grand. But we turn around and sell our new shares at $160, so we're now going to have an increase in our account balance by $16,000 minus any taxes or commissions. And this has been a presentation of Market Taker Mentoring, LLC.